Hello and welcome to MKF 2131 Marketing Decision Analysis. In this video, we are going to discuss the week 12 of our lecture, which is the final week, which is on marketing and finance. So this is a separate sort of entities compared to the other weeks that we have talked about. But there should be some sort of a linkage, as you can see later on. So let's get started. Now, the learning objective for this particular lecture will be discussing the calculation on return on investment. So obviously, in any decision, you're sort of making an investment. So whether you should go through with buying some social media software, for example, and whether would that actually make a return. Whether you are actually making a better decision if you actually acquire this particular factory or so on. So that's what we really want to know. It sort of overlaps with finance or accounting as what you can see. But overall, all business subjects are always interlinked, and that's why we want to go through this with you. Now, particularly, we really want to go through the return on marketing investment, or sometimes it's just short formed or abbreviated as ROMI, the incremental ROMI, which we're going to talk about that, the optimal investment theory, and lastly, how should we compare profitability. And without further ado, let's go ahead. So obviously you know that net profit is sales revenue minus costs. So if you know revenue minus cost, that will give you a profit. Now, the return on sales, which is what we want to know, it's the net profit divided by sales revenue. So in this case, what we want to know is how much of the profit is derived from your sales. Because ultimately, your revenue should have a higher number. Why? Because there will be associated costs in every company. So ROS, or return on sales, is simply the percentage of sales revenue that gets returned to the company as a profit. Now, why is that happening? So let me just show you this particular diagram. So we got the sales of the company, and we also have a variable cost. So variable cost, that is a cost that is basically vary as your production cost is getting higher. So fixed cost is that no matter how much you produce, whether you produce 0 goods or 100 goods, you still have to actually pay this particular cost. Overhead is more complicated. So overhead is like the non-labor costs that are normally spread between departments. So like, for example, there will be a cost for the headquarters costs, or it could be the cost of advertising or so on. So in calculating net profit, we have to take into account all the costs associated with the company, and at the end, you will get your business net profit. So in other way, you will get the net profit divided by the sales revenue, just to see how are you doing. So it can be viewed as a measure of also the profitability, right? So we can see that this is how profitable is the business. But at the same time, you really look at the efficiency of the sales. So how does your sales revenue as compared to your net profit? It can be seen as how efficient are you. So if you think about it, let's say if I can sell $10, right? So let's say this is my sales, $10, and my profit is, let's say, $8. As compared, I'm making the same sales, but I'm only making $1 profit. So obviously, if let's say this is business A and this is business B, you can see that business B are so much non-efficient as compared to business A, right? Because the fact that with the same sales, I'm making so much profit for business A. rather than business speed. So ROS, or return on sales, is typically measured at a firm level. So it's more like you are looking at the firm in general rather than looking at a specific business subsidiary. So for firm with multiple division, all right, so let's just highlight this, multiple division. Overhead is associated with overall firm that cannot be directly tied to one specific division. So like for example, as I said just now, it's like the cost of headquarters. So give you an example like Wesfarmers. So Wesfarmers have a different entities such as Target, Kmart, Officeworks, and so on. And because of that, they basically share the same headquarters, and you can't really pinpoint that, okay, this is a Target's responsibility to pay for the headquarters of Wesfarmers, or you can't say that this is actually a Kmart's problem, or so on. So it has to be sort of directly shared. But how would you actually pay this overhead? Right? So because of that, that's what that can create a bit of problem. Size of different division could also differ widely. So division level profitability might also give a clear picture on overall firm profitability. So like for example, if you think about Target, Officeworks, Kmart, now Kohl's has been already out of Wesfarmers so if you think about Kohl's, Officeworks, and Kmart, they all have sort of different churn rate, they all have different sales. The type of goods that they're selling are very different. Hence, if you actually calculate the ROS by different division, then you might see that, well, they're not doing pretty well. But if you actually combined one Wesfarmers as a whole, it's actually looking pretty okay. So how does firm like Wesfarmers report its overall performance? So what we do is that we ask the company to report the ROS of overall performance of the firm, and then taking different division and overhead into account. Okay, so we're taking the overall performance of the firm, but we also do take into account an individual division. Now in the tutorial, we're going to look at the example of how should we actually look at ROS. So let's take a look at ROS. It's the indicator of profitability, as what we mentioned earlier. So let's take a look at two of these sort of company. So now as you can see, sales is 44.3 billion, net profit is 7.3 billion. Pepsi has so much more sales, for example, but the net profit is 5.4 billion. So you can see that the ROS for Coca-Cola is 16.5 and PepsiCo has only 8.6%. So because of that, although they have so much sales in PepsiCo rather than Coca-Cola, but you can see that the ROS says that they're so much better for Coca-Cola, having lesser sales but increased net profit. So the Coke should have a much more efficient in terms of their operation. Now, what can a firm do to increase its ROS? Now, if you think about it, ROS is equals to your net profit divided by revenue. Now, if we want to break this down, it's going to be revenue minus cost divided by revenue. So it's a very straightforward thing. To increase its ROS, there are two ways of doing it. First, it's you increase your revenue. If you increase your revenue, then obviously, great, you're increasing your ROS, given that costs are stable, right? So increasing revenue, it's one way, or decreasing costs that you can see, right? So there are one way is to increase revenue given that cost is constant, or the second one is to always decrease costs, because when you decrease costs, then obviously your ROS will just drastically goes down. So these are the only two ways of how you should view it. Now, what are some of the limitations of ROS? Now, so ROS doesn't take into account a capital investment. So an example could be buying a machinery, whereby it can be viewed as a cost at the moment, but in the future, it actually might give you so much benefit to the company. So because of that, I think it's very important to see what are some of the things that I have done. So other ways might be for research and development, whereby let's say you are researching on ways to actually improve productivity. Now it might require time and also it might require money. So you actually spend for that research and development. But say that your research and development is fruitful, then obviously it will increase your ROS in the future. Now, it doesn't take into account future performance as what the example I said earlier. So ROS, let's say in here for firms like Facebook, it's very low to start off with until now, right? Where the platform is up and running. In fact, they don't have the cost probably associated with that is just to maintain server and company's employee, and they do some research and development as well. But it doesn't take into account the future performance. So what's happening later on, you can't really see, which is sometimes is useful for investors' point of view, because they want to see the future. They don't want to see now. So that's one of the limitation of ROS. Now, the next one is what we want to go through is EBITDA, right? So EBITDA is earning before interest, taxes, depreciation, and amortization. So if you think about it, it's just net profit. Then you add all this because it's earning before interest, tax, depreciation, and amortization. So you just basically have to add those up. Now, why this is actually useful? Now, if you think about it, in different countries, there are different taxation laws. Now, in Australia, we are applying progressive taxation law, whereby individuals are charged up to 40-ish% and company have the fixed 30%. In other countries, it's different. So I think in Malaysia, it's something around 20-ish%. So much lower in other countries. In Caribbean countries, taxations are pretty much free. So if you think about it, if you have two companies making the exact same money, so let's say if you have company A and company B, exact same money, let's say your profit, it's actually 300 million, okay, and 300 million. But actually because of taxation, the company A, all right, company A, so this is net profit, by the way. So this is actually after you pay taxes and everything. But company A is operating in Australia, and let's say company B is operating in the Caribbean. Let's say we are talking about Cayman, right? So Cayman Island, tax-free, don't have to pay tax for anything. Now, so in here, if you think about it, this guy should have already paid, let's say, 30 million, right, in tax. And in here, you have 0 million tax because it's tax-free in Caribbean. So because of that, well, actually this company the company A is actually making a bit more money, because the fact that after taking into account the taxes, then you still have 300 million. Whereby the company B in Cayman, who does not actually pay taxation, you're still earning the same, which is 300 million. So that's why EBITDA is actually useful, because we want to see, or we want to compare apple to apple. Now, especially this is good when you have when you want to compare two of the same industry, because you want to see whether this company is actually working well or not. So that's why it's a measure of what we call a financial performance. I'm pretty sure you have heard of this before in your other courses, so finance or accounting. Now, ROI is basically return on investment. So I'm pretty sure you have heard of this so many times. It's just saying that how much does the net profit derive from the investment? So if you're making a big investment, whether it actually give you the money back. It's just that. And marketing or marketers always try to understand this number because they also have a target. Like for example, I want to have at least 20% ROI before I really consider. We will do this example a bit later. So you have other metrics, which is return on assets, return of capital, but they all have sort of the same thing, right? The only thing that is different is always the denominator, which is here. So return on asset, it's like basically how much does the net profit is generated from the asset that you purchase. Return on capital, how much does the net profit is generated from the capital. So in here, you have return on marketing investment or ROMI, which is what we're going to talk about. So ROMI is the gross margin minus marketing investment divided by the marketing investment. Now gross margin, it's, okay, I'm just going to add this up. Sales revenue minus cost of goods sold. So it's just basic. Cost of goods sold is basically the cost that you purchase from your previous seller. So say that if you actually sold these goods at $7, but you actually, so that's your revenue from this particular good, but you actually purchased that good for $1. So this is your cost of goods sold and this is your revenue. So your gross margin is $6. So this is what a ROMI is for. So this is your gross margin right here. So you look at this particular, okay, and you have your marketing investment in here, and you want to see, well, sort of the excess return, and how does that actually help you to see whether this investment is actually working well. Now, so you can see in here that revenue refers to additional revenue generated as a result of marketing investment. So we want to see the excess, as you can see right here, is the excess, which is the green line right there. Now the gross margin to capture other costs such as promotional discount, customer service, and so on. And again, future marketing impact are not included in this formula. So that's it for now. So we have gone through all the definitions of different indicators. In the next video, we are going to go through an example to show you how ROMI plays a part in the market. All right, thank you very much, and I'll see you in the next segment of the video.